Hey traders, this is Blake Morrow with Traders Summit, and I have Mr. Jim Welsh because it's Friday. And Jim, what would Fridays be like without you? So it's
Oh, you're such a smooth talker.
good, smooth talker. I don't know about that, but I do love catching up with you every week. And I have to say, this week's price action. You've been looking for a turn in the markets, probably a little prematurely for
Yeah.
the last few weeks. But we are starting to see a little bit of turn in the markets. But I remember us last week discussing gold, and you're like, I'm waiting for a new high and wave five to complete and get a reversal. That we are seeing actually this week, as a lot of people are chasing that in a new high. So I mean, it seems like a lot of price action going on. But more importantly, I'm just saying, not more importantly, I just want to say I also want to reference that today, here we are on a Friday after really kind of a key reversal week that we're seeing in equities. And there's this big cybersecurity breakdown around the
Yeah.
world.
Globally. Yeah.
Yeah, globally, and it's really affecting the markets. I was talking to our traders in our group this week, excuse me, this morning, and I was just telling them, like, after a really underperforming week at the highs, you got this global security risk. There's a lot of trading desks that are down across the globe. What happens, in your opinion, towards the end? I'll tell you what my opinion is, but what happens towards the end of the day if quotes at different desks around the globe aren't really still firing up? What starts to happen at the end of the day in your view?
Well, you would think there would be an urge to reduce exposure
Yeah, especially
just
after
because.
last weekend, right?
Yeah. So, um, again, and Friday in the summertime is typically a lower volume period. But, all the things you just reviewed in terms of market behavior in different markets. It's been a kind of an amazing week. I'm looking for more confirmation of some of these moves, but I think it's an environment where one needs to have tighter stops and so forth. We've talked, let me just, how inside the market, we saw such concentration in a small number of stocks. Then we saw this huge explosion in the Russell, which we'll touch on in a moment. And so to me, as I'm analyzing the market, I'm looking at the semiconductors and the Qs and the Russell 2000 more than I normally would. And we highlighted that last week just because of the rotation that began last week on the idea that the Fed's cutting rates, no recession, cyclical stocks are the place to be. And we saw really an amazing, historic rotation last week.
And Jim, I know we try not to make this, we try not to dabble in political views on Trader Summit or any of our shows that we
Yeah.
do, that I do anyway. But this time, I mean, we have to talk about if it does affect the market. And, obviously the unfortunate events from last weekend, no matter which way you look at it, is unfortunate, but it really tilted the scale towards a second Trump presidency. And I think the market is recognizing that this
Yeah.
week.
Yeah.
His interview in Bloomberg Business Week this week really highlighted the fact that he's not really too happy with the semiconductor industry and how it's been dominated by Taiwan. He's highlighted how the yen's been super weak, how China is manipulating their currency, and talking about tariffs. All that stuff is really going to start to come into play in the markets in the coming months. Wouldn't you think?
Yeah, absolutely. In this week's weekly technical review on Monday, I showed the Time magazine cover of President Trump right after the event when he's holding his fist held high. And to me, that image, is an iconic image that will last probably for a very, very long time. And in people's view, at the same time, thinking of President Biden sometimes appearing to have trouble figuring out which way to leave a stage after a speech. And so, to me, to your point, in terms of coalescing the idea that the election, now favors Trump, those images stick with people.
Oh yeah.
A couple things I wrote about in 2016 and 17. Back then, Trump was talking about the benefits of a weaker dollar. And it's ironic because you and I have discussed the dollar. My take is we're going to see a decline in the dollar index to 93.95. Ultimately, I think 88.90. And so coming in, if it comes to pass that he becomes president, yeah, they're looking at ways to make the U.S. more competitive. And the dollar being one of those levers he's attempting and will attempt to pull to make that happen. So there's no question to me that that is part of the equation, maybe not today and tomorrow, but certainly as we proceed over the next 4 to 6 months.
Yeah, and I'm gonna since I kind of the currency market is obviously my wheelhouse, Jim. It's one of those situations that when if he becomes president again, he's going to come in swinging with tariffs. That's initially that should be dollar positive, but I think that eventually fades because I do agree with you. Now it also depends on who the Treasury Secretary is. Is it Jamie Dimon? And Jamie Dimon, he might be a little bit more defensive of the dollar. But if it's I was talking to Chris Weston of Pepperstone, and he's like, but Lighthizer, yeah, I mean the dollar would absolutely go into a tailspin if that was the Treasury Secretary. And that's one thing that we have to be thinking about as we get closer to the election and he starts to really name some of his key people. We have to be paying really close attention if you're trading the markets and how that's going to affect you. So anyway, I know you brought a lot.
Can I interject one thing? Because I think
sure thing.
It's pertinent to our conversation right now.
Yeah.
When Trump was making these comments back in 2016 and 17, I kind of reviewed the history of the dollar, and everyone's looking at interest rate differentials. What central banks are doing in different countries and how that plays out in the currency market and so forth. And the point I made, Blake, was that the view of the administration is a huge input that I think often is overlooked. So if you go back to the 80s, Reagan was very much in favor of a strong dollar. People forget then the dollar traded up to 164 in early 1995. They came up with the Paris Accord to intentionally lower the value of the dollar. By 87, it was down to 85. Rubin came in under President Clinton. Strong dollar, very much advocate for strong dollar. The dollar was fairly strong during those period of time. When George Bush Jr. came in, he had a guy named Steele as Treasury Secretary. And he made comments like, yeah, we believe in a strong dollar, wink, wink. I mean, that was kind of the way it came across. Hey, guess what? The dollar was 121 in 2001. What it dropped to? Well, it got down to what? 70 in 2008 at the end of President Bush's tenure. So the projection by administrations and what they want matters. And I think a lot. So I'm basically reinforcing your saying that we need to focus on this because historically, I think it's been a bigger issue than most people realize.
100% agree with that. Well, Jim, let's actually dive into some of the charts that you brought that matter. I know you got places to go and people to meet this today. So let's get into it and let's talk about the first slide you brought here regarding the Beige Book. So what does this line mean to us?
Well, all the 12 districts, take the temperature of business in each of their districts, and it gets compiled in the Beige Book, which is then given to the Federal Reserve governors and presidents prior to a meeting. And again, my take has been we're going to see the economy slow more. And this is just one more piece of, I would say, solid evidence, since they look at a lot of detail in these regional surveys and analysis. So again, it's just more signs that, okay, the economy is going to slow. And from the Fed's standpoint, I think the unemployment rate will hold far more import in terms of the decision when to cut than the slowdown in the economy. Again, they've wanted it to slow. So on one hand, this is welcome. On the other hand, they don't want to see the unemployment rate tick up too much. And as it ticks up, I think that will lead them to cut rates because they know if the economy slows and unemployment goes up, what's going to happen to inflation? It's going to go lower. So.
Okay. Well, the next slide you brought up is retail sales. Now, retail sales, this is interesting because everybody saw it as a super, super strong number.
Right.
Like, and by the way, I got to say this, Jim, real quick. Because I'm talking to your demographics here. One of the things that I've before you go into retail sales, I'd love to get your views on this particular point. People are talking that because baby boomers such as yourself, they carry so much of the wealth in the United States. You're seeing this big wealth transfer as they are spending like crazy. So even some analysts are expecting retail sales not even to slow that much as long as the economy does not fall apart or equities don't, or the stock market doesn't fall apart or real estate fall apart. They expect boomers to continue to spend, that YOLO, you only live once type of attitude. And I have to say, from anecdotal personal experience, that of whether it's you're talking about my folks or anybody that I know, their parents that are, in the boomer age, they are spending like crazy. But anyway, I'd love to get your opinion there as you go through this chart, but just something.
Well, I've written about it, Blake, in the sense that net worth since 2019 is up 40% in both housing and equity portfolios and so forth.
Yeah.
And inflation's up a little bit, but if your house value is going up an awful lot and your portfolio is in pretty good shape, you're going to feel pretty good about stuff. But that increase in net worth is a two-edged sword. It's skewed toward the upper 50% and obviously 20% and so forth.
Yeah.
And the other thing is, asset prices change. I'm of the view that we're going to see next year, I think housing prices are going to come down because they got to. I mean, affordability is such a reach. Yeah, when the Fed
so hard,
rate, and the 10-year treasury comes down more, is that going to help? Absolutely. But just pure price levels are pretty crazy. If indeed price levels start coming down, I think you'll see more supply show up. We're already seeing more supply show up. And so my point is, if you get more supply in housing, you're going to see housing prices decline.
Right.
And I think the economy is going to prove to be a little weaker than people expect. And so the risk of a 20 to 30% decline all of a sudden changes the dynamic you're talking to. But it's a reactive function. Just as we've seen people react to big increase in net worth in our spending, if indeed net worth takes a hint, then they're going to pull back. That's just human nature, the way it works. So, and if you get unemployment ticking up, then the bottom 50% are going to respond to that. So to me, a lot is riding on what is going to happen over the next 1 to 2 to 3 years in terms of asset values.
Yeah.
And, I think given where valuations are and so forth, there's more downside risk in my view than upside potential.
Okay. Well, thank you for that. I know that was a off the cuff question, but explain to us what we saw this week with the strong retail sales data.
Well, this is retail sales ex gasoline and autos. As remember, there was a huge outage. No, that was just I think that was in July. Pardon me. But gasoline prices were down over 4.5% in the month of June. That's why the CPI was negative. So they exclude that. So this is kind of like a control group, and it was a good number on this basis. What I'm going to show you next is the average change and all these numbers are seasonally adjusted and not adjusted for inflation. Retail sales aren't adjusted for inflation. So this shows every June retail sales report going back to 1992. And on average, the unadjusted number has been a negative 2.4%. This last June, it was a minus 4.6%. So if it wasn't for seasonal adjustments, the raw data was weaker. So my only point is it doesn't completely ignore what we just talked about. I mean, there's more people going through the turnstiles at airports than ever before. And anecdotally, we know that there's still decent spending going on. But what I try to do is find the cracks in the facade that we don't have to worry about a recession. And I believe that this is another example. Consumption is almost 70% of GDP, and the number underneath the surface wasn't quite as strong as the headline number would suggest. Still a decent number, though. I don't want to oh my God, throw it out the window.
Right. Okay. All right. Very, very fair enough. All right. So the next slide, this is regarding this move that we've seen in the Russell 2000, this rotation.
Yep. So this is from Bespoke. Credit to them that the Russell move was 4.4 standard deviations above its 50-day average. In other words, they're saying, well, what was the actual price relative? And then, 2 standard deviations, I think, covers 93% of all the outcome, just to put it in perspective. And then also, if you look at it, that the Dow Jones Industrial Average has never done this. Going back to 1900, the S&P since 1928, NASDAQ since 1971. So this was an enormous move. Is it a healthy move? I don't think so. I think you have to respect it. But I think there were a lot of people that were long tech and short the Russell. And so some of that dynamic that we saw last week in terms of the tech stocks getting pounded and the Russell going through the roof was a reflection of that. Positioning set this up. The premise is, again, we don't have to worry about a recession. We want to buy cyclical stocks, and the Russell being one of the ways to express that view. And it was an extreme move. Normally, my take is that kind of a move, there's going to be follow through. In other words, people are going to want to buy the first pullback in the Russell because they have this view now that I have to have more cyclical exposure. And a lot of people had cut back on that because it was hurting them in the first 6 months of the year.
Now, Jim, I know the next chart, I don't know if you want me to bring it up right now, but last week you talked about the explosive move in the Russell and how we were going to get this follow through and it was going to drag the rest of the market up. But what we've seen this week is we've seen the Russell kind of stand on its own.
But we got a rebound. Let's look at the next chart on the Russell. Yeah. Look at the semiconductors. All right.
All right.
So I gave some projections last week in terms of, hey, what are the targets? 2282 is a 786 retracement from the high in November 2021. The Russell dropped from 2100 and something to 1645. So the 786 is 2282. It hit 2278. If the rally from 1645 to 2072 was wave A, and then we add that to 1993, you get 4380 or 2370, pardon me. So, and then just looking at the pattern, that kind of a move has to be looked at as a wave 3. And what that implies is the pullback that began in the last day or so is probably a wave 4. And we'll see another move up. And if indeed that happens and we have 5 up, then I think the Russell will be vulnerable to a deeper correction that can take it down towards the 2150 level.
Got it.
So again, people don't give up, the narrative quickly. And given how dramatically it was embraced, I think all the more reason.
Oh, unless there's a major cybersecurity breach globally. Oh, I'm just kidding.
And you can't get any quotes on the Russell 2000.
Right.
I don't know how it is right now, but
yeah, I know.
You couldn't. All right. So
yeah, go ahead.
Okay. So in my letter on Monday, my take was, I think we're going to see another leg down in the semiconductor stocks. That you had an A wave down, we were getting a B wave bounce, and we would see another leg down. My expectation was, and what I wrote in the letter was, 255 to 260. Well, that's because look at the last two lows. We're just above 255. It undercut that a little bit. So right now, to me, one could say this is an ABC. If we get a bounce and then another leg down, so you can count 5 down from that high at 283, that to me would be important given where everything is, in the sense that, okay, we get 5 down, we'll get another bounce, and then there's another bigger leg down. So to me, the next week or so is going to be important. And again, the kind of momentum that we've seen, I think, has to be respected, not just in the Russell, but also in the semiconductor stock.
And I don't want to underscore the importance of, that President Trump interview. He really is just like, Taiwan's taking it all from us. They're dominating the market. This can't be right. And he's going to come hard line. He's going to come out swinging.
Well, again, I think if we roll the clock back a little bit, in 2016 and 17, he was basically saying NATO. Well, according to the agreement of NATO, every country is supposed to, in Europe, contribute 2% of GDP to defense. Most of those countries were under 1%. So he just said, hey, you guys got to start paying up. U.S. is paying 4% of GDP on defense. You guys have to pay up. People immediately said, well, he hates NATO. No, he's asking them to follow through on an agreement that they all signed. Right. I think the same, he's like with Taiwan. You guys we're going to protect you, but you're going to have to start contributing some money to the protection we provide.
Yeah.
And so I just think there's times that people just, because it's Trump, want to blow it out of proportion a little bit or exaggerate stuff.
Sure.
Also remember 2018, he told the Germans, you guys are nuts to depend on Russia for natural gas. The Germans laughed at him. Well, 4 years later, they weren't laughing. So, right. Sometimes we have to separate Donald Trump, the persona, from some of the stuff that he says that actually I think has some value.
Yeah, sure.
I mean, it's easy to react negatively to the persona.
Yeah, you're right. Okay. Off politics, back to charts.
Moving right on.
TLT. Okay, what do you see here?
All right. I still think we're going to see the economy slow. Ultimately, we're going to see TLT close above 95. When it does, the target is above 100. That was the high last December. So as long as we hold above 89, 82, that's a really important level. And, again, my take is the economy is going to slow enough, and TLT is going to have a move higher, and it's going to go above the December high.
Well, I know you've been very downbeat on the dollar, but you have to admit the dollar held up very well this week, mostly due to the euro. So how are you still seeing the dollar at this point?
I still think the dollar is going to probably drop below 102.50 before a more sustainable rally takes place. Again, I think the economy's slowing. The prospects of rate cuts is not a positive. So that's my take.
All right. Very good. We'll just move along then, because nothing's really changed with the dollar. Gold. Yeah. Now this, it's interesting, Jim. I've been warning some people, even on my daily shows that I do with our community over at Forex Analytics. I keep telling people, like, look, I know some LA-ticians, one of them being Jim Welsh, that was looking for a fresh high and then a reversal on gold. But this kind of plays into that, doesn't it?
Yeah, it does. And I had this chart in Monday's weekly technical review. And the point was that whenever the large speculators, which are basically trend followers to a large extent, get over 250,000 contracts that they're long, they're expecting higher prices. Well, you go back to early 2022, late 2020, and both those size positioning led to declines approaching 20%. So, maybe it doesn't go down 20% this time for whatever various reasons, but also with 5 up, it implied that, okay, we've gone from 16, whatever it was, up to 2480. And, that's a pretty big rally. So can gold pull back towards 2200 and retrace, or 2280, whatever, and retrace a big part of that rally? Yes. So To me, holding that 2385 is important. In other words, there's still a chance that you could get one more move up, that we finished 1, 2, 3. This pullback, as sharp as it is a 4, and there's going to be another pop. But bigger picture, as we talked last week, I've written about it, that you got to be looking for the exits at this point in time. Even if longer term I'm bullish, it's like you got to, like May of last year, I thought we were going to see a pretty good sized pullback after we had a spike up, and positioning was part of that problem then, and I think it's still a problem today.
All right, and the thing about gold, and I try to remind our traders about this, Jim, is that there's been a lot of, and it's kind of same with crypto. If you see some selling in asset prices just globally, it's been a lot of, as you pointed out, speculators, large speculators that have been long crypto thanks to fresh ETFs in Ethereum and Bitcoin. A lot of fresh money in gold. Costco's selling gold bars, for crying out loud. There's a lot of new money that's in these assets that, if you see stocks overall maybe pull back over the course of the next several months, maybe into the beginning of 2025, you're probably going to see some of these assets that have been really on the rise. They're going to come off of the highs too.
Whatever has liquidity at some point, if you have a liquidity issue, yeah, and people will sell winners, because I need the money, yeah. They want to hang on to a position, some other position, but they need to raise some cash, they go to the winners. So in a liquidity issue, that's a problem. So I'm not in the camp quite yet that we've seen the final high in the stock market, just because of the momentum, the storyline. What I've said is that the rotation into small caps, in a sense, and the AD line made a new high last week, all right, which was something that was, I think, a potential negative, but it buys a window of time. That story, I think, runs out of gas as soon as we get definitive evidence that the economy's slowing. The whole idea of, let's buy cyclicals. Okay, great. They're beaten down. They've been performing like dogs. Let's rotate. Let's buy the stuff that's been lagging. Oh, yeah, we're not going to have a recession. Fed's going to cut rates. Well, that story will run into a problem if and when we get to the place where, we're seeing more signs of slowing, and the slowing then gets people beginning to get concerned that, well, maybe it's going to slow down enough to lead us into a recession. That, in my view, that's coming. Now, is it 2 months from now? Is it, I don't know precisely, but the data is slowly but surely heading in that direction. And I see no reason why the forces that have been causing that to happen, they're not reversing, so we'll see.
Well, Jim, I want to thank you, for spending your time with us on this Friday, and you do every week. If you guys and gals enjoyed it, make sure you give them a thumbs up and comment down below if there's some comments, that you have from. But I also want to ask, how do traders or viewers get your most recent weekly technical review?
Send me an email, jimwelshmacro@gmail. You can go to the website, macrotides.com, to find out some more information. But that's the way to do it.
All right, Jim, we're going to keep our head on a swivel, always watching our six. And I want to thank you for spending your time with us, and have a great weekend. And I'll look forward to speaking with you next week.
You got it, Blake. Same to you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.